What up, guys? Oh, what's going on, guys? This is Jason, host of Fighting Words Financial. Let's talk markets today. As I'm looking at sort of everything coming to a close right now, it looks like the NASDAQ is up 418 points, roughly 3.4%. The S&P is 1.4%, and the Dow Jones looks like it's down 49 points or 0.1%. Mostly on the back of United Healthcare. That is really dragging down the Dow Jones. Let's remember, the Dow Jones is only 50 stocks. The NASDAQ is, the Dow Jones is only 30 stocks. The NASDAQ is 100. The S&P 500 is, of course, 500 stocks. So those other two are much wider looks at the entire economy. So as you get more and more into investing, you start paying more attention to the broader indices rather than the Dow Jones, although that is the one that the media seems to quote most often. So I had a little bit of a concern brought up today in my Patreon Discord chat when it came to yield curve. And I'm someone that pays attention a lot to the fixed income market, although I don't talk about it very much on this channel because people don't really think about it much if they're stock market investors, and largely because the fixed income field has been dead for the general investor for kind of a long time. But there's some important things going on right now. If you were to Google what does the yield curve look like right now, it would say it looks inverted. And if you pull and inverted yield curve is generally a bad sign for the economy. I'm going to say, though, that a look at the yield curve right now is going to present a very distorted picture as far as what is going on in markets right now. When I say it's pointing a very distorted picture, it's literally because the graph distorts time in this instance. The first more than one half, like 60% of this graph, goes from 1 month to 5 years, and then from 5 years out to 30 years is the last like 40% of the graph or so. So you get a really distorted look at what yields look like. So right now we are in sort of a phase that would suggest we have a coming recession. It's not flashing the warning signs that it was a couple of months ago, like 2-3 months ago, where we have short-term interest rates right now out at 6 months at about 4.8% at the highest, and we have long-term interest rates at the lowest at about 3.4%. This delta seems very high right now, but it's all actually stacked up in the first 5 years of maturities, and we're not really seeing this huge delta between 5-year maturities and 30-year maturities. See how the graph kind of distorts this. This would really, if these were equal measurements of time, this would be stretched out a lot further, and it makes us a lot less impressive where you're looking at an average over that first 5 years of maturity of difference, probably between on average of less than 1% between, a 1 month and a 5 year. It's about 1.2% overall. But if you look out stretched out a little bit more, it probably looks a lot less impressive. But what we have going on right here is a deflattening of the yield curve from 5-year out to 30-year, which is a good sign. And if we look at the actual numbers here, which aren't big enough for you guys to see, we have 5-year in the United States averaging right now at 3.488 and 30-year averaging at 3.5%. And if we look at across developed economies across the world right now, Germany, United Kingdom, Italy, Japan, and China, those rates, although the spreads are pretty tight, they look a lot more normalized than they did in the last couple of months. So the market right now is pricing in more of a mild recession than it was just a few months ago. I think that people understand that as inflation moderates, the consumer is probably going to have a lot more confidence. And also, as we look at job cuts right now, they've sounded a lot scarier than they actually are, especially in light of what's going on with Meta right now. They're not really sending a great message about the health of the company. And I do understand on a pure numbers basis why the stock went up so much. But in my mind today, Meta has really surrendered its place as a risk on growth stock, meaning one that I am willing to take a lot of risk on and own as an individual stock because I think it's going to outperform the market going forward. I do not think that's the case anymore at this point. And I think there's a lot of risk with wrapped up in their transition to the metaverse. I don't believe that they have a strategy to really exploit the metaverse. And the way I'm looking at metaverse strategies being successful, I'm really looking at the augmented reality technologies that are going to be available for industry and for business rather than for gameplay and that sort of thing. Although I do think that's going to be successful one of these days. I don't know how much time people want to spend in a VR set. When you look at their virtual reality business right now, it's turned out to be a $13-14 billion weight hanging from their necks, and it's going to get worse. So it's not a good look for Meta when they cut 11,000 jobs last year, something like 13% of their workforce. They're looking to cut a few more jobs in the coming year. That by itself is not all that concerning for the company. Zuckerberg did mention the word efficiency something like 16 or 17 different times during the live stream of the quarterly results. But what really concerns me is the $40 billion share buyback. They are more focused. They're sending a signal right now that they're more focused on returning shareholder equity than they are on growing the business of the company, which means, in my mind, that they have surrendered the idea that they are a growth company, and they're basically not that much better than a utility company at this point. That's a bit of an exaggeration, okay, but it is a sign that they've really changed the corner. And I think that in my investing experience, this may be the fastest that a company has gone from a growth stock to sort of blue chip like performance and expectation going forward, meaning that the Meta might see some fairly decent participation with the market as it rises a little bit further. But at some point, I believe this year, in the absence of the beginning of real monetization of the metaverse and showing that they really have and they're really sort of first place in this technology, or at least a leader, I think in the absence of that, we start to see expectations for returns in for Meta stock become more like blue chip stocks, more like consumer staples, more like something like that, right? Less like utility, like I said before, that was an exaggeration, but more like consumer staples, and that's kind of the way I see them going forward. It looks like we are seeing a few positive signs on the advertising front. It does look like not YouTube Shorts, but shorts from Instagram are finally starting to gain some traction. How well they monetize that and how that compares to TikTok is yet to be seen. I think a big help for them would be, of course, if TikTok were to no longer be allowed in the United States. I don't know if that's going to happen or not. And I don't really have an opinion on whether or not that should be allowed or not. I don't know enough about the security concerns when it comes to China's control over that data. But I will say that even then, it's not really clear that folks who use TikTok are going to be able to monetize what goes on Instagram in the same way. And it may leave room for YouTube Shorts to make a much bigger inroads into that space that TikTok has claimed, right? TikTok essentially created an entirely new market for short form video. I really think that they looked at Vine as sort of a successful experiment that was never properly monetized, and they kind of grew on that, and a couple of other platforms as well. And they kind of grew on that. It could be, though, that the move that Congress made doesn't directly benefit Meta as much as we think, and it ends up benefiting YouTube instead. So I'm sure YouTube is probably going to be happy to hear this if the YouTube overlords are paying attention to what a small YouTube like myself is. But so open to questions, guys. Didn't want to say, so that was for Doug B, who's a Patreon member, when I was talking about the yield curve. And that was a question that I just didn't address in the Discord chat this morning that I wanted to address on the live stream. And I hope you are paying attention. So evening all, says Michael Will from Australia. And Canada says present and paying attention. So excellent. Like I said, we're open for questions today. I don't believe in non-monetization. this particular live stream. I forget to do that occasionally. So if you're trying to send me a super chat or something like that, give me a moment or so, because it's not going to work right away because I don't have monetization turned on. But okay. So back to markets today. One of the things that's happened over the last month or so is the rally has been really, really broad. And pretty much the only sectors that showed life in 2022 are the only ones that are down this year. And that is going to be consumer staples, energy, and health. And I think consumer staples is actually, so I think that is something to pay attention to, is that the breadth of this rally is fairly impressive. And like I said, way back on October 13th, when I kind of called the bottom back then at around 3,600, that I think that the breadth of the rally at that point sort of signaled the bottom. I think that the breadth of the rally at this point signals the beginning of a newish bull market at this point. That is not to say, though, that we are not going to have an intermediate period of concern, which I think we will, and that's going to come with the debt ceiling fight. I think that's going to pretty much affect all stocks that are out there, and I think that's something that you should pay attention to and be ready to capitalize on, because that is going to be temporary and very short-lived. The United States default on debt fight is going to happen in Congress purely for political reasons. Everyone wants to have their say on the budget. In the end, nothing really important is going to happen until the actual budget talks that happen September through November. We're going to have some sort of temporary Band-Aid. I'm sorry, Michael. Yes, I did make a mistake there. I realized that as I was saying that I realized that it might have been the UK there. So, so the budget fight is going to happen. Basically, the one party is going to demand that to compromise on the debt limit, they have to promise that there are going to be serious talks about the budget come September and November. We are going to see something cut out of the budget, probably that basically sends a political signal, but doesn't do any real good. Kind of like when $100 million, I think in 2009 or something, was cut out of the White House budget by the Obama administration. It was entirely symbolic, didn't really do anything to help out with the sort of $4 trillion we added to the debt in that year. But people can say every little bit counts, but that little bit doesn't really count. We have to have serious conversations about what we want to do with the budget here in the U.S., and no one seems willing to do that because every subject seems to invite the idea that it is political suicide. So, I would love to hear intelligent comments on budget at some point, but I generally don't get those through any sort of media, including my own. There's not a lot of honest discussion about that. But okay. So back to what is going on in markets today. Apple is should be reporting right now. It should have their news conference here just in the next half an hour or so. So I'm not sure what's going on with Apple, but I think Apple and Amazon are releasing right now. And let's see. So Apple reports after Amazon reports afterwards. All eyes are on Amazon's cloud computing arm. How about the run-up right now in everything related to AI? If you are an investor in NVIDIA and you're an investor in any other AI stocks at this point, you've been the beneficiary of a pretty large run-up. I think that was really triggered by the enthusiasm for ChatGPT. I would be interested right now if I had positions where I had short-term commitment to those positions. I think I'd be interested right now in hedging those bets at this point. I'm definitely interested in buying the hedges that people are putting on those bets right now, because my time horizon is probably a lot longer than most people's. But particularly if you have owned was it NVIDIA, I think they got as low as like $108, $115 a share just in the last couple of months. And now last time I looked earlier, they're up to like $200, ridiculous like that. So they are doing really, really well. So the NASDAQ is up more than 16% this year. It's actually up more than 20% this year since this article was put out this morning. or something like that. And it's the best start of the year since 1975. So that sort of first week phenomenon, first month phenomenon, or anomaly when it comes to the market, is basically states this: that the first full trading week of the year for the market, if the market is positive, then it's probably an indication that the market will be positive for the entire year. And that's always true. There are exceptions, but I think it's like 70% of the time, if the market is up in the first full trading week, remember on the share full trading, then it's generally going to be positive for the entire year. So I think that's a pretty great sign. But yeah, so a lot of things going on right now in the market that seem very positive on the face of it, meaning that we're looking at, particularly the financials, their results have been good to not as bad as expected, which is really good, actually. But let's also remember that the full effect of quantitative tightening here, really, the tightening the money supply and a declining M2, a shrinking M2 money supply, that full effect has not been felt on lending at this point. Right now, it's all in the minds of lenders. We have not really seen a tightening of lending requirements. We have not really seen a decrease in the availability of cash out there to lend. That is coming down the road, and it may lead to an earnings recession later on in the year, where we see banks and particularly financials not necessarily meet expectations for Q1, Q2, and Q3 of this year before we see some catch up at the end of the year. So when I went over SoFi's earnings and their guidance earlier this week, there were a few points that I kind of brought up in comments later on during the week. But most financial companies out there, on average, are predicting that the U.S. economy is going to grow this year at a rate of somewhere around 0.5% as an annual rate for the entire year, meaning we have one or two bad quarters before we start building our economy again at a clip of about 3% annually. And it's going to give us an overall rate for the GDP growth for the year 0.5%. SoFi's prediction in that and how they base their forward guidance was quite a bit more pessimistic than that. They were betting on a contraction in the U.S. economy of almost 2.5%, of 2.5%, actually. That's quite a bit more pessimistic than most financial companies out there. And they are also betting on 2 quarter point rate declines at the end of the year. I think that it is far less likely that we are going to see those 2 rate decreases at the end of the year, because in my mind right now, something that I never expected to happen is possibly going to happen, and that's a soft landing. It may be that we see an earnings recession, but that unemployment never really cracks and is sustained over that 5% mark. And it may be that we still see some inflationary pressures, and by the end of the year, we may stop or have a pause in interest rate rises, but we may not see a contraction in those rises or decline in the interest rate at the end of the year like some people are expecting. Now, the market has priced in at this point at least 2 decreases by year end, by 2023. The Fed is saying it's not going to happen. The market is pricing it in. At this point, to a degree, the market is fighting the Fed, which leads me to believe that this market rally is probably going to cool a bit. I'm not saying that I see a retracement back to 3,600 for the S&P 500. I definitely don't see that at this point, but we could see the S&P bounce off of 3,800 or so because of the debt ceiling fight coming in June or so, and that might provide some opportunity. And honestly, that might be the last opportunity before we see a major run in the markets. But I do see some bit of retracement right now. It's been too far, too fast. The breadth of the expansion has been pretty large. And a lot of the stocks that I'm looking at right now, whose financials really have not suffered that much, but they were vastly overvalued in 2021. They got knocked down to when they were undervalued. Now they're pretty close to fair value again, particularly when you calculate the amount of excess return that you need over a risk-free investment right now, I think that fair market value for some of the stocks we're looking at right now is already approaching fair market value. Not necessarily for growth stocks that are experiencing a loss right now. There is not really a fair way to calculate what fair market value is. But for companies with current cash flows that are in the technology space, they're approaching fair market value at this point. And so I'm thinking that the rally runs out of steam. I'd love to be wrong. I would really love to be wrong about that. So, Deweese says, someday I'd like to know how after hours trading works. I suppose I could Google that. Actually, I don't know where you are, but in the US, there are plenty of platforms now that allow after hours trading. A lot of them available right through your phone. It used to be something that you could do if you worked at a brokerage house, like back in the 1990s, when I actually worked in a brokerage house on the IT side. I was fascinated by the idea of after hours trading. And at that point, it was a lot of guys who were trading in the after hours and recording their trades to this network. And I can't remember what the name of the network was, but they were literally just talking it over between themselves, trying to rectify their books at the end of the day and make themselves look better. This whole business model, I think the company I worked with actually ended up getting busted for being illegal because people were sharing gains, which has basically never been legal unless you were a hedge fund. Meaning that back in the old days when it was actually difficult to do online trading, I had a couple of buddies of mine who started working for this company in Houston, Texas. They would sit behind a desk all day and day trade stocks with someone else's money. And the idea is they'd split the money 50-50, which I think is an absolutely ridiculous split. And literally I could do math at that point. And I was like, well, I could just buy an index fund and make 12% a year. Back then the market was averaging 12% a year and make 12% a year. Why am I going to do that and make 6% a year, have higher taxes, more commissions that I'm paying, a lot more in the commissions, because this was at a time when it was anywhere from $40 to $50 per trade, and that was considered cheap. Like you used to pay a per share transaction fee that used to be like close to 50 cents per transaction, which was absolutely horrible. Well, great for the person who was selling you the stock. That was also back in the day when stock brokers actually brokered stock. Today, a stock broker doesn't really have the same role. Like your financial advisor at the bank or at Morgan Stanley doesn't sell you stock anymore on a per share basis. And back then they used to get paid like 50 cents per share or something like that. So, the idea that you'd go out and sell, 5,000 shares or something meant that you'd make, $2,500 in commission for a single trade, which back then was quite a bit of money. All that has changed now. That per share transaction, because of competition in the space, because of democratization of trading, all that has gone away, and that is likely to stay that way. What is happening now is even a further innovation on the whole idea of paying per transaction, and now you're really paying a fee for order routing. And companies that can get the most transactions going through the systems are the ones that are going to make the most money, because they're making smaller, they're higher volumes of trades, but much smaller commissions off of those. They're still paying a commission, guys. You just don't realize it. Okay. Open for any questions today on individual stocks. Did want to cover SoFi today because SoFi has just been completely nuts. So SoFi up again, 34 cents today, or about 4.61% after I think a 9% gain yesterday. This is on just momentum at this point. How much longer this momentum lasts, I'm not really sure. After hours, it's down 19 cents. Not really sure why it's down after hours 19 cents. It's on no news once again. I will say one thing, that I have shifted my strategy when it comes to SoFi. My average cost on SoFi was high enough that I wasn't really selling any covered calls on the stock because I didn't get away. So it's been not making me any money at this point. I've been selling puts and then buying a little bit more here and there, but it really hasn't been in high volumes because it makes up so much of my overall portfolio already. But I have kind of shifted strategy at this point. I'm willing to take a lot more risk on the stock, particularly because they may be profitable by fourth quarter of 2023, first quarter of 2024, second quarter of 2024. What I'm betting on is profitability by first quarter of 2024 rather than fourth quarter of 2023. So I've started to buy calls further and further out at strike prices that are out of the money at this point, but not that far out of the money. I'm talking your $8, your $10 by June, was it June 19th or something like that? Whatever that expiration date is. And I think that it'll likely stick above $10 by the middle of June. And it'll keep growing after that. There's been some predictions through the comments on my channel that SoFi could be $20 by end of year or by 2024. I kind of dismissed those as being unrealistic. As I commented on my community channel today, there is a non-zero chance of that happening now, and it is becoming more likely day by day as people recognize just how much progress this company is making, just how much that progress has been uninterrupted, even when they faced some serious challenges in the macro environment, particularly having their biggest moneymaker taken away from them, and how they had a near miraculous pivot to other types of lending. We're probably looking at the housing market coming back to life a little bit as people will buy houses. Whether or not the cost of capital is high or not, you're still going to have people that can afford to buy houses. Competition in that space is going to be more fierce. And SoFi's cost of capital has just been radically reduced by the bank charter and by the more than $7 billion in assets that they were able to gather last year. And I expect that asset gathering in terms of checking and saving accounts is going to grow, and it's going to continue to lower the cost. Like the $30 million in interest income, that's nice. $30 million per quarter, that certainly adds, another, 7-8% onto their revenue. That's nice. What really is the impressive thing, though, is how it lowers their cost of funding loans going forward. They've cut out a middleman when it comes to that. And I was looking at the platform today, too, in terms of like small business lending. And I'm really wondering when SoFi Technologies no longer farms out small business lending to other people, and that becomes something that they handle on their own as well. I'm hoping that comes this year. But the next announcement that I expect from SoFi that is going to impress me, which probably won't impress a lot of people, is SoFi Bank issued CDs. They already do business in brokered CDs, which is something they get a commission from. That's just matching up a buyer and a seller of some other bank CDs. They do that through the brokerage account. But the CDs that they sell from SoFi Bank feed into the deposit base, which can then be turned around and loaned out to someone else. And that really is going to lower their cost of doing business. Before, they had to pay not so much onerous fees for custodianship and for access to capital, but that is going away to a degree. So yeah, I am very excited about what's going on in that space. So looking at other headlines today, when it comes to CNBC here, Bitcoin on the nothing was a terrible sign. I don't know. I think the estimates are only like 24%, or I think that's before. Not necessarily terrible as it definitely could have been. Let me see. Beats on fourth quarter that I sold those calls earlier. So yeah. Chris Palmer says, I'm late to the party, but so glad I made it. Don't mind me. I'll be scrubbing to the beginning of the video. Excellent. If you have any questions, go ahead and fire away, guys. I'm not sure that this one's going to last all that long today, largely just because I need to rest up a little bit before I have to go in and teach classes, and because I haven't been sleeping all that well lately. So I'm going to take a nap in the middle of the day. I feel like a Gen Z person napping in the middle of the workday, but hey, man, I can do it. So I will. So Alphabet misses on earnings and revenue as YouTube falls short. Amazon beats on fourth quarter, but provides light guidance. You can expect based on those giants, I think. And Ford posts an ugly fourth quarter, full year net loss as execution issues plague production. Well, you can expect the rally to be over. And Michael Will says, hadn't understood the last 30 seconds as your signal was bad. Yeah, I really don't know how to solve that, guys. Maybe actually my computer connection end, because my connection is supposed to be first right now, at least every time I go and test it. But I think that I'm not looking at futures right now, but I would bet that futures are absolutely crashing. If we take a look at them here, that futures are actually going to start crashing. I think futures actually start trading. We'll actually see them in the next 20 minutes or so. But yeah, so I would not expect necessarily that the rally continues tomorrow based on Alphabet and Ford earnings, which are probably not awesome. So let me see here. Alphabet to report earnings as growth slows on smartphones. Alphabet misses on earnings as ad revenue falls, and Amazon stock drops after revenue beat, EPS miss. Well, like I said, not excellent. And we can expect some sort of market reaction tomorrow. I think today's Thursday, right? So tomorrow will be Friday. It's the last day of the week. We may see a down day that day, and another nice. And we have a long weekend to sort of digest all the economic news, and people will probably come back a little bit more positive next Tuesday. Actually, that's holidays not till next week. So let me see here. Looks like Apple has not reported yet, or at least I'm not seeing any news that they reported anything out yet. So, but that'll just take a few moments. And as I'm doing these live streams at right at 1:00, I actually pull up on. But let's look at one of the bad boys here. It's reporting, and we'll see how bad the carnage. Google. Not sure why that happened. Let's see how bad the carnage is. That's going to be interesting. Yeah, it's got to be my computer on this end, guys, because my issues. It's pretty old, so down 2.95%. The slaughter might get a little bit worse here after hours. Let me see here. EMZN is probably next. And honestly, man, Amazon has shot up quite a bit in the last couple of weeks too. Like I think it got down to a low of like 84 or something like that, and that was pretty good. A pretty good entry point. And I think that was actually a really good entry point at that point. But right now we're looking at, and remember, P/E ratio is something when it comes to the history of trading Amazon that you probably shouldn't pay all that much attention to. It's never been what you would consider a value stock. Probably not since like 2002 has it been a value stock. It's always been something that you're buying, knowing that it's overvalued, and sort of walking into that. So, yeah, I would expect that we're going to see a reaction in stock market futures, and in NASDAQ and S&P 500 futures, and it's going to be a fairly negative one. And tomorrow we're going to have a rough day of trading. So if you were looking to stretch throughout one more day before we got out or into something, it looks like all of those plans were ruined. And I apologize if you were one of the people that got caught out on that. I don't know why I'm apologizing. It wasn't my decision. But yeah. So, all right, folks, this is about all the time that I have. If I don't have any questions, so I'm going to go ahead and call this a day for right now. Earlier part of the live stream is probably where I had the most amount to say, and that was really about Meta Platforms. I think they sent a really strong signal today that their time as a growth stock is over. And like the $40 billion share buyback, it's great for supporting the share price. It's great for, reducing the float that is out there. It's terrible that they're not taking that $40 billion and investing it in growth and growth of the company. That means that they've kind of run out of ideas in a lot of cases. It's not always the case that a share buyback is a bad problem or is a bad idea, but in this case, I think that it is. I think it's kind of a desperation move, and I really couldn't understand all of the praise that I heard for Mark Zuckerberg on this call, just because he used the word efficiencies a number of times. The job cuts has probably cost Meta Platforms about 4.6 billion in severance. It probably saved them about $88,000 to $90,000 based on the estimates I'm seeing. $88,000 to $90,000 per employee that they cut. At some point, some of those employees are going to, not some of those jobs, but new jobs will come back to Meta Platforms at some point. And it looks like they're going to cut a few more jobs here in the first and second quarter. But it's the $40 billion share buyback that I find really disappointing at this point in the development. I think that's a pretty good indicator that their days as an innovator may actually be limited. And that's where I'm going to close for today. This is a very short live stream, but that's I just have a few things to do today. I am still working on my video on the Toast platform. I've been out interviewing like restaurant owners and that this software you at Bar Trump that I'm an investor in, and myself, I don't own any Toast, but that is my next video that's coming out. It's a deep dive on Toast and talking about kind of the evolution of why the company that I'm invested in ended up using this software, why I think other folks are going to turn to it, and how I'm already seeing it kind of taking over the industry, at least locally, which is, of course, a biased look at things. But at least locally, it's kind of taking over the industry. And we'll talk about some other competitors as well. So I look forward to seeing you guys next time, and have a nice day.